Justin and Mikhail have really done a great job of getting this organization off the ground and moving with our first event. We'll be having a similar one to come as later in the spring. But for tonight, welcome. It's Tech IPOs, and we're going to talk about the process from the beginning to the end, but really mostly focused on not just the specific laws that govern the process, but really what the actors actually do in the process, and how the lawyers really interact with the business folks to make this process come to fruition. All right, so I know there's a substantial number of people from the business school, and also from the law school, so I hope that there's going to be something for everybody here from what our panel members are going to discuss. Well, at this point, let me turn it over to Professor Lerner. He's going to introduce our panel members, and when he's done, I'll take it back, and I'm going to moderate the event. But really, it's going to be an informal discussion, and we'll let the panelists do all the talking. I'll just seek to guide the process throughout, and then we'll have questions at the very end. But for now, Professor Lerner.
All right. So thank you all for coming very much. This is really exciting. We haven't had a business law society yet, which is really kind of crazy, and so it's really lovely to see everybody here. It's a really exciting inaugural event. We should all give a big round of applause to Mikhail Brandon and. Okay, they're too shy to stand up and wave, but it's really exciting. I practiced law in Silicon Valley before coming to Los Angeles, and then after that I taught at Berkeley, and so I was kind of neck deep in tech and in the entrepreneurial spirit of Silicon Valley. And then I came here and quickly became neck deep both in tech and in entertainment law, particularly with documentary filmmakers and creators. So it's really fun to see this type of panel here. It's really exciting. I was actually at Sonsini for several years. I didn't know if you knew that, Asia, but
yeah, they check behind you.
oh, very good. Yeah. So it's really thrilling. It's funny because I called Alison Spinner, your partner at Wilson, to say, can you possibly give us the names to in-house counsel who had done IPOs recently, and we didn't get a chance to talk, but we had other meetings. So I'm not going to say too much. We've got some people who have much more hands-on experience than I do about this, and so I just want to introduce our guests, and we're just absolutely thrilled to have them here. So Peter Astiz. Astiz is a global co-head of the technology sector practice at DLA Piper. He's been practicing for over 30 years, providing general counsel service for high technology companies. In particular, a lot of experience with IPOs. Recently, you represented the underwriters in the Groupon IPO, as well as representing Salesforce.com in a recent IPO. Next to him is Lisa Stimmel, who's a partner at Wilson, Sonsini, Gould Society, my old firm from many years ago. And you focus more on complex corporate governance, SEC compliance, 34 Act disclosure matters, and you were involved with the LinkedIn IPO, so very interesting IPO there. Rob Carlson is here from Hastings, and Rob is more, I would say, of an M&A expert as opposed to IPO. Would that be accurate characterization? Obviously, it's a little bit of generalization. Wide variety of corporate experience for Rob. And Blake Welcher is Executive Vice President and General Counsel and Corporate Secretary for DTS, responsible for legal affairs worldwide. So we've got a variety of lawyers here from firms as well as in-house. So with that, I will turn it over to Professor Scotten.
All right, just one, I forgot one little plug. There's a cocktail reception that's going to be following this in about an hour. So we really encourage you to come to that, not just for the great free food and drink, but also so you can talk more personally with the panelists and get some ideas from what they do. But let's get started. I actually asked Rob to kick it off, and just to start the process tonight, I'd like to, this is a slide from a PowerPoint that he had created from another presentation, but it just lays out the process for an IPO. So this is what we're going to be speaking about tonight, so I'd like you just to take a moment to go through the timeline to put our conversation in context of an IPO. Rob?
Thanks, Professor Scott. One of the reasons I chose this slide was it's the kind of slide that the investment bankers produce, and it's the most unrealistic slide of the whole IPO process. I think it's just before I start the timeline, I just want to step back and talk about who some of the players are in the IPO process, because again, you have some lawyers, you have some future lawyers and future business folks who are going to be investment bankers or other professions, and I want to just talk about what everybody does in the IPO process. So, a company is looking to going public in the United States. Let's say they're going to the United States. They need lawyers to represent them in the IPO process. They need accountants to audit their financial statements, because you need 3 years of financial statements to go public in the U.S. You need underwriters typically to do the IPO process, because the underwriters are going to offer the securities to the public. And the underwriters have a lot of work to do, and they are working side by side with lawyers, and they have their own lawyers that they hire as well. All of us on this panel have done both for issuers and for underwriters in public offerings. So in this IPO process, the investment bankers, together with the company management, drive that process. The bankers want to get a deal done at the right time, when the market is hot, whatever that means, when there's demand for the securities. For example, Facebook filed their S1 February 1st. Their goal is to get into the SEC comment process, get through that, do the roadshow, complete. That could take, depending on how long the SEC comment process is, but maybe May of this year they'll actually be a public company and the public can buy and sell their securities. As lawyers, we have to do the disclaimer that you never know how long things are going to take. But this is the general timeline of what happens, and again, the number of days can vary quite a bit with every offering. I did one IPO, in fact, with a 6 to 8 weeks. I would say it'd be more like 52 weeks. Where the company was trying to figure out what their business model was. They were an internet company, and sometimes the hardest part is describing what is our show going to be to the investor, what we can talk about. So you hire legal counsel and the underwriters. You draft the S1, that's the main document, the registration statement that gets filed with the SEC. It becomes the basis for the prospectus that you use to market the company. You start the due diligence process, the legal due diligence, the accounting due diligence, the financial due diligence, the operational due diligence. The lawyers, the accountants, the underwriters are all involved in this process. And corporate governance changes. Now, I actually mention this because I think a lot of companies don't realize that you don't just file an S1 and you're public and you're done. The process of going public is a long process, and you need to have good advisors who are part of it. I've had another one of these panels I did, another speaker said that really you want to practice being public for a year before you go public, and I thought that was very good advice. You want to have a board of directors that's solid, that understands your business. You want to have your audit committee established. You want to have your compensation committee ready. You want to have good, solid management that will know how to sell your company, not just internally, but to investors, because investors are the ones who are going to make a decision about whether they want to buy your stock or not. When you get through that whole process, then you file, hopefully, the S1 registration statement with the SEC. And that's when you begin the process of being in registration. You do a listing application with the NYSE or the NASDAQ, wherever you're going to list your shares. And then the underwriters work in tandem, prepare roadshow materials, underwriting agreements, comfort letters for the auditors to do. Again, we can go over this in more detail as we go along, but all of these things are working in process while the SEC registration process is going. The SEC has 30 days to review your initial filing. They come back with comments. They're usually legal and accounting kind of divide in those two main sections. And then everybody gets involved in responding to those SEC comments, both by letter or phone calls with the SEC, and then they actually file an amendment to the S1. So you'll see, for example, Zynga went public in December. We had a client that was a shareholder in Zynga. They filed their S1, they filed 9 amendments before they actually finally went public. You never know how many amendments you're going to get. Part of it's a function of what the SEC comment period is. There could be other factors that go on. When you get through the SEC comment period, you do all the S1 amendments. Again, 6 to 10 weeks, who knows? You get the final, the red herring. That's the document that you use. You've gotten through enough of the SEC comments so you feel like there aren't going to be any material changes to your registration statement, and you hit the roadshow. And Blake's going to talk about the roadshow because he's lived through it. They don't like to have the lawyers go on the roadshow because we're worried about what we're going to tell them to say or not to say. Well, we may hear. That's right. Roadshow can be a week, 2 weeks, longer. It could be in the U.S., it could be in Europe, it could be all over, wherever the accounts are, where the investors are located as you try to sell the stock, and then you try in the roadshow to be consistent with what you say in the S1 registration statement and not go beyond it. Talk about what happens when you don't do that. You don't follow that. Hopefully you get through all that, there's enough investor interest, and then you go ahead and you price the IPO, day of pricing. It often happens to just magically fall in the range of $12 to $15 a share. And then so it sounds like a good deal. You price it, and then you close in T+3, and you're public. And your stock is being traded, and then you have to deal with all the life of being public, which again, Blake can talk about. It's not the end of the road, it's actually the beginning of a whole new life for companies. I think that one of the big misconceptions that founders have is that if I go public, my work is done. Well, you've gotten public, which is a major accomplishment, but in many ways your work is just beginning to deal with working life as a public company.
Yeah, I can't overemphasize Rob's couple points on its slide there, the beginning slide of that. The preparation going in, the more you can do, the better. And oftentimes you don't have that luxury. Sometimes you're under the gun for whatever reason to get out as quickly as you can. But I love the concept of practicing being public for a year, because it is very, very different. Even though the day before and the day after you went effective, there's no difference in your company. Same people in general, same things. The game has changed. The game has changed dramatically. You're under the quarterly clock. You're filing obligations. Mistakes can be catastrophic. And these whole pieces, it's a different process. All right, it's short of possibly liquidity and maybe some market access. I think if you take, and I haven't done a scientific poll in this one, but if you ask most public companies, if you had those two, would you remain private? I think the answer would be yes, because it is a tremendous amount.
Blake, just take a moment and talk before the council get hired, all right, to start the process off. What's happening on the business side, in the business house, to prepare for the point when you actually call the investment banker, you actually call the lawyers?
Well, in our case, I can point back to DTS, and my experience here is fairly limited. It's to this company. I, like a lot of you, did not come from this sector. My background happens to be in intellectual property. I moved into a general counsel's role for a private company that dealt with technology licensing. And so usually in my mind what happens is probably one of two things I touched on. There's a need for liquidity of some capacity, or there's some type of market access that would give you some freedom to do other things that you couldn't necessarily do as a private company. And in our case, it was quite similar. We had a series of venture capitalists who were in the company for about 7 years, getting a little long for their holding period. They were looking to make an exit strategy coming out of it. We had some debt obligations that were coming due in a couple of years. Probably could have refinanced those, but we would have probably been a painful experience with the insiders and the refinancing. And we had been out talking to a number of people, both from a strategic and financial investment perspective around the world, about an opportunity with our company. That being said, at that point in time, the valuations we were getting coming back from these opportunities were pretty small, or they were low. And the bankers we started talking with were saying, hey, you could get 2 or 3 times that number if you took this company public. Pretty enticing, especially from a shareholder return perspective, you could do that. And so at that point, we started looking seriously about making this process. And I remember sitting with our CEO and our CFO, and we made a decision to do this. And I walked out going, oh crap, what did we just agree to? Because it was, that whole process took off. We were at an interesting point. We were in late 2002. If you remember, that was when the first Iraq war had ended. And so the markets were incredibly choppy. I mean, probably no different than they are today. There have been like 6 IPOs in the last 18 months, some of them marginally successful. And so we took that chance to go out. The other part Rob touched on, and other people chime in too, was that process is really, really consuming. I mean, you're talking, probably we spent at that point in time $1.5 million in legal fees and accounting fees, and that was, 8 years ago. Okay, it's definitely gone up since then. And the workload on management is tremendous. At best, if you prep for that, it's 2x your normal day job. If you haven't, it's 3 or 4x your day job. And at the time when it's most critical that you run your business, now's the time you don't want to stumble. And you're getting it all together. So we had finally made the decision that this was the right thing to try, and we started doing that process. Because there were so few IPOs, we didn't have a lot of pressure. And so we did a lot of what Rob was talking about, kind of in a sense of praxis. We could lead it in. And so we did a lot of prep work external to the printer. And these guys can talk about the printer, which is a whole different world. If you've never gone to a financial printer, it's unbelievable. And started doing a lot of stuff. We had prepared along the way for for a lot of the stuff because we were doing these private placement attempts. So we had financials that were audited. Our parents at the time were Universal Studios, and we had a relationship with Steven Spielberg. So we were the most publicly looking, privately traded company you'd ever seen in your life. And so we had done a lot of that prep work going in. We really saw board members, had done most of the parts. And I think that's what helped our process be as smooth as it could be, because you will get curveballs.
Peter and Lisa, if you guys can focus on the LinkedIn and the group on IPOs, at the point in which they call, business folks call you, you get involved at that point. What's happening at your level when the business team calls you at the very beginning?
I can speak. LinkedIn was a little bit of a unique animal in that they actually had other counsel that had been with them when they were a private company. And then shortly before, I think once they were sort of ramping up their IPO process, and their IPO process was a little different. It was more, I think, sort of what Facebook is facing now. Once you hit 500 stockholders, you have to register with the SEC and produce financial information and do all of these things, regardless of whether or not your stock is publicly traded. And so, you know, for example, Google was the first one. When they filed their first S-1, they also had to file to become a publicly traded company and provide financial information because they were going over 500 stockholders. So LinkedIn was facing a similar thing. So they were just kind of in a phase where they knew they had this window. But in any case, they actually went out and were looking for new legal counsel. So where a lot of companies have an interview process for investment banks, LinkedIn also did that for legal counsel. So we actually stepped in slightly before sort of the IPO, the official IPO kickoff process, and had to sort of take them on as a client, get up to speed on what their sort of current legal status was, and then move on from there. So I think we were a little bit behind the 8 ball, whereas hopefully what you're in a position of is you've been, as a lawyer's been living and dying with this company for the last few years, you know their capitalization, and you know their contracts, you know a lot of these things. We were getting up to speed sort of together with the Underwriters Council all at the same time. But I think usually the company is helping to, or the lawyers for the company are ideally when they're starting this process, helping them to, you know, what are our governance structures going to look like? What are our, you know, you want to list on one of the major exchanges with NYSE or NASDAQ, you need to have, as Rob mentioned, an audit committee, a comp committee, a nominating and governance committee. Is our board properly composed? Do we have all the necessary documentation to facilitate that process and get out in front of that? So a lot of that is what company counsel is doing sort of at the beginning, hoping, because once you file that S1, it goes, there's just things coming at you at all the time, and there's not a lot of time to really think and put a lot of thought process into some of these other things that you will live with as a public company.
What I just add to that is described in most circumstances, the company counsel and the IPO has been with the company for some period of time. And so one of the key things and one of the great things about being a technology lawyer, which is somewhat different than, say, being a Wall Street capital markets lawyer, is that we're intimately involved with the companies. And many times we were there at the very beginning and starting the company. And so we're a business advisor through that whole process. And as you're looking at the uncertainties and the timing of when to do a transaction, we're in the boardroom, we're talking about it, we're using the experiences that we've had to kind of help educate everybody and to be kind of an objective participant in that process. So it's not, our starting launch point isn't really when the deal is actually launched, except in kind of unusual circumstances. It's been in continuous. And then the other thing is that there's big differences between different kinds of companies. There's kind of the elite circumstances where you've got very well prepared companies that, because of their shareholders and their financial circumstances, have invested a lot of money in preparing. So in case, for example, when I did the Salesforce, we had 5 lawyers internally at the time of the IPO. I've done a lot of IPOs where there's no lawyers internally. And so the difference between how well prepared companies are and how much time they've actually spent that year practicing being public, or whether somebody has just said, hey, the market's open, let's try to get a deal done. The nature of our jobs are dramatically different based upon all those circumstances. And if they've not been prepared, then our job is just to take as much as we can off of management's shoulders and help them get more involved in drafting what the story is, getting more involved in doing things that in a more orderly process maybe the company could do over a bigger period of time. The other thing I want to talk about the differences between the high-profile transactions and kind of the run-of-the-mill IPOs is that there's a lot of uncertainty, not just about the timing, but the uncertainty about whether these deals actually happen in this kind of environment. And you know, Facebook, Zynga, Groupon, LinkedIn, those kind of companies can get a deal done in virtually any market. I mean, their valuation will change based upon what the market is going to be, but basically others. But there are over 200 companies that are in registration right now, and then if you ask me to bet, most of them, more than half of them, are not going to get an IPO done. So these are a lot of companies that have gone through the process who are speculating that they're going to get this valuation that these investment bankers, is kind of, since we don't have any on the panel, I can say they're like real estate brokers. Yeah, they come to the company and they show them in this very fancy presentation about why their company can be worth $500 million or $1 billion or $2 billion, because they show all these comparables to other situations. It's just like showing a house. But the reality is that nobody ever gets the price for their house that the real estate broker out there can get. And sometimes we've found out in the last few years you can't sell your house. And that's exactly what's going on in the IPO market a lot. That the companies are, you know, convinced that they're going to get this good price, which is a huge multiple over what they would have gotten if they tried to sell the company. And then they go in and they can spend a couple $1 million on lawyers and accountants trying to get this deal going, and then they're sitting out there. And so a lot of the things that we're advising in this process is the cautionary aspects of making sure that people are realistic about what's going to happen. Do they have enough financing to pay our bills, among other reasons, as you're going through the process, because you don't want to try to finance a company if you're already in the middle of an IPO process. So there's a lot of business advice, and you really, as part of our role as a business counselor, is really understanding that dynamic, how it fits in the kind of the life cycle of the company.
And some companies, I just got thrown in, are actually pursuing a dual track. They'll be doing the IPO process while also potentially exploring an M&A exit. Those are different, two different ways to do it.
So Rob, if I can come back to you, bring us to the next one now. And if you can focus on what are the associates and the junior level underwriter business folks doing at that point?
All the fun stuff.
Besides working at the morning.
Besides working 100 hours a week. Yeah, it's. I think I'll just talk about the lawyers do. When you're a junior attorney, you are primarily doing what's called due diligence, which maybe you guys have covered in law school. What it is. It's everything you need to know about the company to prepare it for going public. Are its articles and bylaws correct? Are its, does it have a board? What are its committees? What are their form contracts? What's their litigation going on? I'm just thinking about all the things that you disclose in the registration statement about your company. The idea is that you want to make sure if there are any legal issues about the company, let's get them dealt with now. We don't want to have a big surprise down the road. One of the biggest risks that technology companies face, I do some in biotech, this is one of the areas, is the threat of being sued in a patent infringement claim. And when you're a private company, maybe you're not as out there and known, but if you've got a drug or a technology that might be covered by somebody else's patent, they may want to wait until you file that S1 and then come in and get you and invite you to take a license or just bring you to court, and then you've got a real serious those business surprises that you've got to worry about. So as a lawyer, you're trying to prepare for all the things that could go wrong. What are the issues that investors are going to focus on? What litigation do you have? Are your employment agreements correct? Do you own the technology that your employees, when they invented it, they assign it to the company? Does the company actually own it? So the work that the junior attorney is doing is a lot of those kind of reviews that at the time seem like, when's this ever going to matter? All I can tell you is that if something isn't correct, it's going to be found out, and it's going to be ugly if you're in the registration process, or even worse, already public. I'd say the other due diligence aspect from the business side is you're trying to make sure the company, what it's saying about its projections of its revenues are going to meet. The accountants are going to be doing their work on, if they haven't been auditing the financials along the way, they've got a lot of work to do to audit. The underwriters need to make sure that they understand what the auditors are doing. If there's numbers in there that are not audited, what kind of comfort are they going to get from the auditors on those numbers and the methodology? So everybody's doing due diligence on the company. They're examining the company to make sure that everything that's going to go in the prospectus should go in there, and that what is in there is true.
Can I ask a follow-up question there, Rob?
Sure.
It strikes me there must be checklists that you all have when you're ready to go into due diligence. So you give the junior associates on your team,
Yes.
okay, here's the 25 things we got to find out. let's get to work. Is that
Yeah, it would
the
be
case?
probably 25 sections, and there's 10 subcomponents to those 25 sections. Yeah. The organizational documents, the minutes, the tax, the financial, it's the checklist that you've probably seen.
And I think every company is different too to some capacity. Issue 1 will happen with company 1, issue 2 will happen with company 2. It's just because they're different animals.
But what's interesting about the document review or due diligence is that you don't, you can't just say, okay, do we have financials? Do we have this? You have to say, are the financials right? Do the numbers add up? Are there typos that you have to reissue or whatever it is, right? So it's interesting. You learn a lot about the business through due diligence.
Absolutely.
And the other thing in parallel, partly is this due diligence process of reviewing documents to find out information and identify some of the issues that have been discussed. In parallel, what you're doing is preparing a verification of all the information that's actually in what gets filed with the S1, and that gets done different ways by different kinds of transactions. But essentially, what you're looking for is verification of every statement that's in the document. That's your ideal goal. You don't necessarily always get there, but the point is that to provide the defense for the company or the underwriters who are obtaining underwriters that you actually verify this information, and that's why there's some differences in the document between information that has a verification or an expertise portion, like the information that the accountant sign off, that creates a defense for everybody else. And other information, if you say that the market size is X or Y, or that the company has the very best product, you have every statement in the document needs to be justified. The product has these kinds of features. Well, how do you establish that the product has that kind of features? Well, you need to have a product manual or something that gives you some evidence to verify. And that's, that document, as you've seen them, are quite thick. So there's a lot of information that has to be verified, and that's, again, a lot of the role of the junior lawyers, trying to chase down that in cooperation with the client, making sure that all that backup is available for everyone.
In fact, one closing dinner I went to where I was representing underwriters, the CFO of the issuer presented me with an encyclopedia at the closing dinner. He said, because you ask me all the time, what's your backup for all these factual statements? So here's your encyclopedia of everything in the world. So I guess I had annoyed the heck out of him. It was established that due diligence defense that underwriters have, that they've done an investigation of the company and the company's provided them with information, and so that is the due diligence defense that underwriters can have if there's a claim of material mistake or omission in the prospectus.
Lisa, can you speak to the LinkedIn? Who was the underwriter at LinkedIn, and how is the interaction between the lawyers and the underwriters? At what levels? At the junior associate levels? At the senior partner level? How do those teams work together to coalesce and bring the due diligence issues together?
And also, perhaps you could define what underwriter means in the context of an IPO. Many people here might not understand that.
So the lead underwriter in LinkedIn's IPO was Morgan Stanley, who is also the Facebook lead underwriter. Then there was some other team members as well. You'll know some of the cover prospectus, but at least in this case, Morgan Stanley was really the true lead in this, and so kind of was the one driving the process, and the other bankers sort of, for lack of a better term, drafted off them on the process and sort of the efficiencies of having them. And a lot of that's driven by deal economics and other things that are probably too much detail to get into here. But the underwriters essentially they go out and they have the accounts and they are the first line of how the securities get distributed to the public. So as a practical matter, what really happens is the company sells securities to the underwriters, and then the underwriters sell to their accounts. And so you'll see on the cover page of a prospectus that there's the price to the public, and then there's the underwriter's discount, which is right around 7% for an IPO. And so the price that the company actually gets for its securities is 7% less than what the price of the public is. So LinkedIn's price to the public was $45 a share. What the underwriters actually paid LinkedIn was 93% of that. So that was the money that went to the company and the selling stockholders in our case that were selling shares. So that's sort of the basics there. And then the underwriters and the lawyers work together, I think, at all levels, and in large part because the underwriters have their own counsel as well. So there's a lot of interaction between the underwriters counsel and the company counsel, but then also between the underwriters and the lawyers. And I think One of the interesting jobs of the lawyers, right, is especially when you're company counsel, is the company wants to go out and market itself in this fantastic way, and they've probably been running a business that's pretty successful, and they've been marketing themselves in a certain way. That's not necessarily the best way to market to the investing public, and it's not necessarily the same things that you can or would be willing to say to the investing public. And so trying to strike that balance between what the lawyers are comfortable with and what the business and the underwriters, frankly, want to push you to say because they're trying to put out the best story possible for the company. The lawyers are the ones kind of pulling them back, going, I don't know if that's quite the way you want to say that. I mean, I think you look at any private company, and the first sentence in any press release they say is, blah, blah, blah company, the leading whatever, the leading provider of this, the leading internet site on the web. And the first thing a lawyer will do is cross out B and put A, and you're a leading provider of something. And it's just, that is a constant balance throughout the process.
Blake, from the business perspective, who are you looking at? I mean, you call them your lawyers, you call them the underwriters. Who are you looking to lead the process? Who did you look at?
Excuse me. In our experience, it was, again, the lead underwriter is the one who's kind of driving the bus to some capacity, coupled with, it was in this case our counsel at the time, which was, and so they were kind of driving the process. Now, hopefully, you've also got a team, because you're packed in this room, especially during the drafting sessions on IPS 1, you're packed in a room with basically about 25 people. And so you got this combination of people. Hopefully these guys all get along, because you're on some long, late nights, especially when you're at the printer, just before you start to file. I mean, all-nighters are not uncommon. It's not uncommon to leave at 4 in the morning, you're back at 8, so you get 4 hours of kind of some type of sleep. And so tensions can get a little testy in some of those areas. So again, we want to make sure that it's accurately represented. We have our counsel that's making sure that we've got it done. And you've got the underwriter side coming back the other way, trying to find that middle balance between the two. So it's kind of a combination of all the above.
And one of the key roles for the lawyers is to manage that process. Particularly the lead company lawyers, that's the main role, is to sit in that room and make sure that the conversation is constructive. So when you have different circumstances, and for an example, what you do on some deals is we just had Morgan and Goldman, and we just had private meetings before we brought in all the rest of the banks. So we had a much smaller group to put this thing together until we brought other people in. In other transactions, you can have 5 or 6 banks in the room, and everybody's trying to justify why they're there and throw in their 2 cents. And you write one sentence, and everybody agrees with that sentence, and the next week everybody throws it out, and they go, this one week before. And it's a very tedious process in that respect. So the role of the company lawyers, and hopefully and generally all the lawyers are working together on this, is to just make it narrow. So every week you're making progress to the point where you're ready to file that document. And it's usually not the drafting of the document that is the timing factor as to whether or not you're going to file. It's usually because your audit's not done, or there's some market issue, or some other reason, because ultimately people do understand that it has to get done. It's like a term paper. It's due at a certain date. It's going to be what it is. Either you're going to be really proud of it, or you're going to wonder what the SEC is going to do. It's due, the bell's ringing, and you're going to get an F if you don't get it in. So that's the process for it.
Okay, Rob, can you bring us now to the effective date? So the S1's done, SEC signs off. What happens here at this point?
Talking about when you've gotten all the way to the
Yeah, we're jumping up
price.
Yeah.
Well, then if you sign, you basically have closed the transaction. The stock is now sold it to the investors. The underwriters have sold it to the investors. The investors are there. There's a book that they've built called a book. They've sold it to the investors, and so you close the transaction. The shares are issued to the underwriters. The underwriters sell the investors. The 93 cents on the dollar come back to the company, and the shares begin immediately trading on whatever exchange they're listed on. Again, NYSE and NASDAQ are the most common. If you're doing overseas, there's other, obviously, growing number of listings on the Hong Kong exchanges and in the PRC that are gaining a lot of popularity. There's still a lot of desire to be on NYSE and NASDAQ. Those are very well-respected exchanges. People are used to it. By that time, you've gotten through all the whole roadshow. You've gotten through all the amendments to the S1. You've signed the underwriting agreement. You've gotten the final comfort letters from the accountants. You've gotten the final 10b-5 opinions from the lawyers, which I'll just touch on for a second. One of the other reasons why you have the due diligence process that you have With the lawyers and what the junior folks are really doing is, at the end of the day, whatever is in that registration statement, the investment bankers are smart. They have the lawyers give them an opinion that there are no material misstatements or omissions, i.e. there's no 10b-5 violation in the registration statement and the prospectus. And so the lawyers provide that statement in connection with the IPO. The accountants also provide those comfort letters that I was talking about. Again, all this is done so the underwriters can sell their accounts and basically say, you know, this offering is materially true, and we relied on company, we relied on the counsel, both the company counsel and underwriters counsel. Underwriters counsel does their own 10b-5, and the accountants to give us a comfort letter. So if the underwriters, they try to minimize as much risk as possible. That's one way of looking at it. From the underwriter's perspective, they'd say, look, we're just trying to make sure that our due diligence is verified. The company is giving us, you know, the truth. So that's the, now you're public, and now your shares are being traded, and they can, you know, trade at wildly different numbers right off the bat, and you're off and running.
I jumped too fast. I meant to ask about the roadshow right before that. If you just speak for 1 minute.
Yeah, I think Blake would be a great. I mean, the roadshow again. They don't want to have the lawyers there because we may look at the roadshow materials and make sure they're consistent with what's in the S1. But this is where the company likes to be able to tell its story, and it's more of a sale job. It's what makes the lawyers nervous because you get that the leading words kind of creep back in there as opposed to a leading. So go ahead.
So my experience, again, is limited, but as Rob touched on, it's not common that the lawyers get to go. As I mentioned, we're an audio technology company. So one of our big mottos at the time was, shut up and hit play. I can talk on blue, but when you hear our technology, you get it pretty quickly. There's an area of the law called Reg FD, which stands for fair disclosure, and certain limitations of what you can and can't do in certain environments. So I was the most, and being an engineer by background, I was the roadie that they could take along to set the equipment up and run it, who wouldn't script the Reg FD issues. And so that's how I partially got nominated for this roadshow. Plus I wanted to kind of get the experience, you know, from a more senior management person in the process. So it's a process of going from usually sales location to location. So the underwriters are basically salespeople. And they're out talking their accounts and starting to flog the opportunity here. You guys need to get in, and et cetera. And so you start going from city to city with a number of these things, basically giving the same presentation that you polish down time after time after time again. And so I went out for the first week on the roadshow, and at the beginning it's kind of cool. So you have breakfast in Boston, you have lunch in New York, and you have dinner in Chicago. That's pretty cool for the first couple of times. After doing that for like 2 weeks, it gets really, really old. And our CFO was joking about it. He says, the only way I knew what city I was in is at the airport I looked at the car in front of me, and then I could look at what state we were in, and then I knew where we were basically at. We, at the end of the process, did like a tour. You've seen like the concert tours about the road show. And because they'd gone to Europe and over to Asia and the US, and so we had this whole big process. So it is an interesting experience, but again, it's fairly controlled. You want to kind of keep it there. And it's the opportunity to flog the company. So why do you want to invest? Typically, they want to see 2 people. They want to see the CEO, the gentleman or the woman who's running the show, and they want to see the person who's in charge of the money. The rest doesn't matter a lot. So us in the legal, they really don't want to see me behind the scenes. Being an IP licensing company, I did get a number of questions on the roadshow.
Lisa and Peter, what was your role, if any, in the roadshow for your IPOs? And also, how important is the roadshow for the major IPOs that occur?
Well, again, I think the role is pretty common in terms of just reviewing the materials. Now you have, because of more recent developments, some of the SEC registration process, you have a publicly available net roadshow for most companies, and you can actually watch these presentations that are given by the companies on the web. So again, we work with it. It goes through several iterations of the draft, depending upon, again, how much they want us to interfere with that process. Sometimes you see every draft, but then they stop showing it to you, and then right at the end they say, we're going to finalize this in 15 minutes, so this is your last chance. And so, like most things, our job is to put the brakes on a lot of things, and then sometimes we have to negotiate a little bit and figure out what we think are the really most important things. Because a lot of things are gray about what's going on there. So we do that, and then afterwards, then we sit back and really, while the deal's being on the roadshow, when the sales process is going on, the lawyers are getting ready to how to go through the closing process and some of the background documents, but our work is unless there's some problem, our work is largely completed that point in the process.
I've been lucky enough to have a couple disasters while my companies are out on the road. Not necessarily, not in LinkedIn, but I had another one where the company's out on the road and one of the directors got on CNBC and started talking about how this new technology that they were coming out with was going to be the greatest thing ever. Nothing sends lawyers into a panic more than someone from the company doing this. You know, there's ways that you file. We had to file free writing prospectuses with the SEC and do various things. Basically, take liability on everything this guy said, other than what we could go back through and correct and say he said this, which is, as you can imagine, pretty embarrassing for the company that your director's standing up there saying X, Y, Z, and the company has to go and say, well, he said X, that's not really true, it's really Y, and this. It was a mess. On LinkedIn's IPO, they actually had good news in that they were out on the road and getting indications of price that were higher than we actually thought they were going to be. I mean, this is all public information. We thought you filed the red herring with a price range, and this is based on what the bankers kind of think the price range is going to be, and it's usually within $2, $3 around that. And then you go out on the road and you start getting indications of what people are going to pay for this. And so if it's getting above your range, then you go and you file an amendment to increase your range and do things. There's some securities law reasons why you want to do that. So that was sort of us as a week into the roadshow putting together this amendment to make sure that we updated the range and making sure that we were comfortable with the revised range, because what you don't want to do is file with a higher range and then come back below that when you actually price the deal. So those are some of the things that come up that I think, all things being equal, if everything goes well, you're pretty much just preparing for the closing and hoping that you're getting documents in order and things like that, the closing and for that first day when the company goes out and starts trading. And I think that's another interesting thing too, that it's a little bit of a timing thing. So you price and you start trading on day one, but there's actually no delivery of the shares into the market for 3 additional days. So it's just it's speculation, frankly, on some level that you said you're going to offer X amount of shares in the market, but there's no shares out there actually trading. It's just electronic transfers going back and forth between brokers and things like that. So those first few days are pretty interesting because things could, and I've never had it happen to me. I don't know if you guys have ever had anything happen, but theoretically the whole thing could blow up in that 3-day period and you could never deliver shares into the market. And
yeah, it's funny how I can remember that because our directors became very concerned about where we were going during that 3-day period. It was like, you guys can't travel anywhere for 3 days. I guess there was I heard the story, you guys may know better than I do, about a case named Osborne Computers, where they basically did that. And the CEO and a few of these guys went and bought new cars, and basically one of the guys launched off the road and killed him. And my understanding is it imploded a good part of that entire deal because the management team was no longer there.
Yeah, well, there was a CEO on I don't know, have not Osborne, but there's another computer company where that happened. He bought a Ferrari the first day. But maybe talk a little bit about the pricing mechanism that Lisa was referring to. I mean, so you understand when you hear these wild gyrations in pricing and going up and down, there's been references made to the book. And what happens is that these underwriters, who are the salesmen, are going and they're talking to various accounts. So they're talking to Fidelity, they're talking to Putnam, they're talking to all the major institutional investors and lots of private names that you wouldn't necessarily be so familiar. And they're asking them, do you want in? What do you want to go in? And the investors will respond depending upon what their interests are in various ways. Sometimes they'll say something like, well, I'll buy 1 million shares at $10, and I'll buy 500,000 shares at $11, and I'll buy 100,000 shares at $12, meaning their price sensitivity will affect how much they want to buy in that transaction. Or maybe they'll just give one price and one share. And then all of these potential orders are lined up in what's called the book. And you go back, and then based upon what all those indications of interest are, the investment bankers have a sense of what they think the aftermarket appetite for that transaction is. So you never, a lot of what's written about this stuff, as most things that are written in the press, are really not very accurate about the reality of what's going on. But ultimately, what you want to do is have a price that gives the company a fair price for its shares, but also has upside associated with it so that investors can make money. Because if investors don't think that they can make money, the stock's going to go right down. So basically they're looking at these orders that are coming in, and the underwriters come to the company with a recommendation of what the price is based upon these orders and what they think the price is going to come out at. That will have some nice uptick, but not a huge uptick. But it's not a science, okay? You don't know, particularly the hotter the transaction, it's much more uncertain. Because you don't really know if you can get 45, is the stock going to double after you get 45? If you ask for 50, is that going to change the psychology completely the opposite, and it's not even going to go up? Because again, it's money chasing money, so everybody's speculating whether it's going to go up or down. So it's a very interesting process on these very volatile transactions that people are trying to gain, and everybody has different perspectives. Some boards are very say, I want every dollar that we can get. You know, some people say, I want a successful deal for me is one that is going to go way up, you know, and it just, the personalities, the determination. Most companies are fairly accepting of what the underwriters make recommendations to them on and think that the underwriters are the experts. And then, of course, you've got boards that think that they're experts and they're going to go in and they know what all this stuff should be going on. So we don't have a role so much except for explaining how the SEC procedures work around those pricing changes, but we're often right in the middle of that dialogue, which is very interesting to kind of see what the dynamic is. And after the fact, if the stories were really written about how some of these decisions were made, it would be quite surprising. I mean, I don't think usually we can talk about them because they're rich conversations, but it's a very dynamic process. And again, that's on the high-profile transactions. But the more average transaction, where they've kind of got a price range and they're going to price between the low end of it, the $10 or the $12, they're just wanting to get that deal done. There's far less excitement around that process.
Let's do this. We had a guided discussion from the beginning, the business decision to have an IPO, all the way to the pricing and the closing. Let's open it up. You guys have, I'm sure, lots of questions for our panelists. So let's take questions from the floor. Anybody? Yes, sir.
Geographically, where does a lot of the work get done? I mean, if the company is based on the West Coast, but the underwriter is based in New York, are you doing a lot of work in Los Angeles, or are you going across country to go do work somewhere else? Does it depend on what type of work you're doing?
Usually the underwriters come to the company. So you see a bunch of bankers in New York who are coming west, and they won't wear a tie, even though they would normally wear a tie in New York. So I'm being a New York guy, I guess today. And they come out, and it's always funny because I'm always like, you don't really have an outfit without a tie. But so they'll come out here and do a lot of the work on the ground of the company. You actually have, with a lot of underwriters, and every firm is different, but you may have a industry expert on the West Coast, and you may have a capital markets person back in New York who's really building the book and working with the investors, because a lot of the investors are based on the East Coast. And that's just where the kind of center of gravity is for a lot of investment bankers, is New York. I don't know what other people think. That's kind of mine.
Yeah, on the tech side, most people have their tech headquarters, the banks in Silicon Valley, so that's where the tech folks are. As you said, they're the capital markets guys in New York. I'll give you one example of this. A long time ago, I had a client, a company called Borland's, a software company, which we took public in the UK first, and all the bankers came out from the UK, and all the auditors from the UK, and the lawyers from the UK, and they came, and this company didn't have any place for anybody to meet. So we met in the back of this little tiny Chinese restaurant called Silicon Valley Chinese, with one of those little curtains that you could put in, the little round tables. And to see the look of these guys walking into this room, they had no idea what they were going to expect, and this is what doing an IPO in the Silicon Valley was. But at the end of the process, the most interesting thing is one of the auditors had to stay behind because he was doing all the work at the company while everybody went back. And at the end of that deal, he had a great tan and became a great surfer, so he never went back to the UK.
But one of the things I think is important is the bank that you ultimately get aligned with is somebody who typically does business in the space you're in. If you're in biotech, if you're in a entertainment technology sector, or something like that. And to Peter's point, they have a tendency to be in the zones where you probably are, because that's on the net in the areas that you're working in, which is where your customers are, et cetera. So there's a natural kind of nucleus in a lot of those areas. Otherwise, they come out. because they were, we were back in New York or back in Boston, and we had SG Cowan lead ours. They were headquartered out of Boston. The folks came out here.
And I think it's just the other, I forgot to mention, Blake touched on it, is you want, as a company, you want coverage from these investment banks once you go public.
That's correct.
So you need really good analysts within that investment banking firm who understand your space.
Yeah.
And so they can, cover it, make a buy recommendation, hopefully, to investors to buy your stock. That's really, so again, that IPO process, a lot of what goes into selecting which investment bank you're going to go with is who's got the strong analyst. That's always one of the first questions management asks is, who's your analyst? I mean, yes, I want to know who the MD is that's taking me out, but I really want to know who your analyst is and really understands my space.
And really respected analysts, because they're the ones that are going to follow your company, give insight to investors within their areas about the pros, the cons, the trajectories of the company. It's really key. Because if you don't have analyst coverage, you can be almost dead.
Another question? Good.
Yeah, Peter had mentioned that there's many companies that register, but only a real few actually go IPO. Is the main determining factor is not getting enough institutional bankers to really buy into the IPO, or is it something different?
Well, I'd say a couple things. First off, there's it depends. The statistics depend upon what period you're looking at. Okay, so there were big boom periods like 1999, 2000, internet bubble where almost anybody. I actually took a company public and we had $25,000 of revenue in the quarter before we went public and raised $85 million. So that was iTunes before iTunes. But so it really depends upon the period. And what's happened now is that you have in the really big picture going on is a lot of long in the tooth companies, okay, and where the average time to liquidity in prior periods was 4 years or something like that, and now they're getting stretched out, which means they're not getting sold, which means their investors haven't gotten liquidity, and the venture capital returns over the last 10 years have not been very good. So there's a whole bunch of dynamics that are leading to people to have a little bit more desperation to find liquidity. And because of that desperation, and they're not finding a buyer to buy them that's going to give them this great premium to have it. So they're going into a registration process with more uncertainty than in traditional times. So yes, at the end of the day, if the determinant of whether or not they can go is whether the institutional investors have enough of an appetite for the transactions. And if you look at last year's performance, half the deals went down. It's not like there's demand and say, I want to get that deal because I missed the last one. And that's every time people talk about the next one, whether it's going to be LinkedIn or whether Groupon or Zynga or coming up Facebook, you're kind of hoping that there's a draft behind it. The deal is very successful in drafts and everybody wants to get in other transactions and create some enthusiasm because it's a market, right? And you want people to all feel like it's all going to go up. And when that happens, then more companies can get through. But if you look at overall economic issues and uncertainties in Europe, et cetera, and election cycles, it's kind of hard to imagine that you're going to have a boom IPO year in 2012. So those companies will still be there.
Lisa, for LinkedIn specifically, they offered a very small amount of shares to, I guess, try and get that first day pop. Where I remember watching it on CNBC, they went off like extremely high on the first day. Is the investment bankers or the lawyers like telling the company we want to offer this little stock to do this on the first day, or is it the company that's trying to make that decision? Who's driving that process?
I think from a very just basic level, that wasn't engineered, that wasn't planned. I mean, I went to bed and we priced at 45 and I woke up and they were trading at 107 and I just remember going, oh my goodness, and like got in the car to drive to the office and it was 120 by the time I got to the office. I mean, no one expected that. I think, as Peter mentioned, there's all sorts of uncertainty and you're a private company, you get all these indications from the bank, but you have no idea what the market, what's going to happen. The day traders and the people that are flipping your stock out there, you have no idea what sort of appetite that's going to have. The volume that LinkedIn offered was not in any way related to price. It was much more, I think, about appetite of stockholders for dilution. And I think you see a lot in these cases of companies in different places, depending on whether or not they need money. I think you'll see some of these companies are going out and going public because they do need liquidity and they do need money and they do need things. Facebook, they're making plenty of money. The reason they're going public is because they're hitting this 500 stockholder limit, and they're going to have to become a reporting company, and they might as well get some money for them and some easy liquidity for their stockholders out of that. I think you end up with different dynamics in that case, with the number of shares being offered and things like that. So there's a lot of dynamics that go into that. LinkedIn also offered all of its employees an opportunity to sell in the deal, and there wasn't an appetite among the employees to sell. So that's something you can't control as well. So there's a lot of factors that go into these things that are very company specific, that are, I think, completely and wholly unrelated to any sort of idea about the pricing.
Yeah, I don't think many companies, again, if pricing is done on an artificial basis, it will disappear, because that's the way markets work. So I don't think many companies are driven by that. And one key thing, these larger transactions where you're doing under 10%, if it's a bigger transaction, so on Group 1, for example, we did 750 million, and I forget what was 7%, whatever, but the point is it's 750 million. So there can be a company that's doing a $50 million IPO and selling 25% of the company, but they only have $50 million of market cap, so market caps are, but $50 million of stock that's actually trading in the market. So if you want to talk about liquidity and true pricing, actually the aggregate size of the transaction is more of a factor than what percentage of the company is actually offered.
Is there a question over here? Saw a hand earlier? No?
So
Yes, go
I
ahead.
actually have a few questions. Lisa mentioned about underwriters, and I wanted to understand their function a little bit better. So assuming that an issuer decides to issue, let's say, 10 million shares, right? Is the underwriter obligated to take up all the shares which is not purchased by the other investors, or do the underwriters only act as an agent to try and sell it to the other investors? So assuming, like, let's say maybe 2 million shares are not taken up, do the underwriters have to take up the 2 million? Is that part of their underwriting arrangement?
It depends on what the underwriting arrangement is. If it's the typical underwriting, the classic IPO, the underwriter is actually obligated to purchase the shares, but it'll only take that obligation on if it's got built the book and knows it can resell them to investors. Sometimes underwriters act as placement agents, where they actually don't take title of the securities. So the shares are sold directly by the company to the investors.
So they effectively only act as placement agent even though they're called an underwriter?
And there's a lot of debate about whether a placement agent really is an underwriter for legal liability purposes.
Yeah.
But the underwriters like to take the position that if I'm a placement agent, I never take title of the securities, I'm not really an underwriter for liability
You want
purposes.
to talk a little bit about the market-making function sometimes they play too.
Yeah, I mean, when they're out there in the market, they're often doing hedging as underwriters to make sure that the price is stable, and there's a lot of ways that the underwriters do that, but that's part of what they do. They use what's called the over-allotment option in part to help with that. There's 15% of the securities on top of what gets sold in the initial IPO are usually held back and are option shares that the underwriters can buy. And then and they do that, it helps in part to hedge the risk, the exposure they've had through the underwriting process in the initial public offering. So the typical IPO you'll have, I'm sure Facebook will be the same way, you're selling this many shares in the IPO, and then there's an over-allotment option for the underwriters, it's 15%, they have to exercise within a certain number of days after the IPO.
So just to add to that, there's no contractual agreement doing any part of this process until the effective date. Okay, so you're working with the underwriter. In theory, the company could fire the underwriter at any time, or the underwriter could walk away from the transaction. So it's when, at effective date, you go effective with the SEC declares a registration statement effective sometime in the afternoon, these go before they close off. And then you price the transaction. How close you do depends upon how much uncertainty, if you're still dealing with all these accounts and stuff like that. And as soon as you price the transaction, the underwriters are confirming with their accounts who's getting the shares. So they have sold those shares literally minutes after they've signed this agreement to agree. So they're not in the risk. There are other risk, this market-making elements, and they're in and out of the market. But fundamentally, they commit to buy a number of shares that they're certain that they're going to sell.
I see. Okay.
And the underwriting agreement will say, the lead underwriter is buying this many shares, and then there's usually whoever else is part of the group is going to, you've got an allocation among the underwriters how many shares they're going to buy. And again, as Peter said, they've already sold those. They're not going to take the risk of buying them if they haven't sold them already.
I see.
An agreement to sell them.
Okay, my other question was in relation to the pricing mechanism. So basically, they go out with their book rate, and then they collect all these offers that they have from all these other various investors. are these offers actually real offers? So for example, when they decide on a price, anybody who offers a price which is higher, they will actually sell it at that higher price, or all these investors will buy it at that same price?
Everything has to be sold at the same price. The price to the public is the same. So.
But this, I noticed that they only reach out to all those major financial big investors. How do they reach the general public?
They don't.
This is the US, come on.
No, I'm just trying to like, understand how it works.
I mean, some deals will have some amount of retail, what they call a retail component, which is the general public, but on a hot deal, that's reserved for the very best customers, for the very best banks. So, or, you know, the average person cannot get into a hot transaction except.
So they will have to wait for it to be listed.
And that's why the price keeps on going up, because everybody's jumping in, trying to, you know, get their piece of it.
Got a question over here?
Yeah, so you all briefly mentioned different exchanges that companies might want to trade on. What are the factors that go into deciding what company or what exchange a company wants to go on, and what happens if they want to be on a couple different exchanges? So maybe they want to be in New York and Hong Kong.
Well, yeah, go ahead.
I was just going to say, I think there's a lot of things that go into it. I mean, a lot of companies we're seeing now are waiting to pick what exchange they're trading on. It used to be all tech companies went to NASDAQ and kind of blue chip old industrial companies went to NYSE, and that's just the way it worked. A couple of years ago that started changing. Some of it has to do with just very basic things. Price of listing on each exchange. NYSE is a little bit more expensive. They have different listing requirements, different corporate governance requirements, different things like that. Some clients get pitches from both exchanges and just feel like one of them really gets their business better, which is kind of a funny way to pick, you know, an exchange, but there's really no reason not to. I think you're seeing, you know, we've got a couple of years ago, companies started dual listing on exchanges. We don't really see that quite so much anymore. But if you want to list, I think, in, you know, Hong Kong at some point, I don't see that in initial, right at the IPO time, and that's something that I've seen happen later in the process, but usually what we deal with in the US is somebody that wants to go with NYSE or NASDAQ, and then occasionally we get people that, it's an Australian-based company, so they want to trade in Australia or something.
And, you know, the advantage of doing dual listing is the possibility of more liquidity in the stock. You know, maybe somebody's more comfortable trading on a certain exchange, but aggregately, say you're initially doing the initial public offering, you maybe go with one, you know, pick NYSE or NASDAQ, or be doing it in Hong Kong, you'll do it on Hong Kong exchange. And then you may want to branch out to another, you know, exchange later on. Another
A
stock
lot of that
exchange.
does the home court. You know, you're there, that's where your kind of base is. Certain exchanges may have less restrictive rules in terms of compliance with corporate governance, and so there may be reasons that people may steer from one to the other, especially in foreign jurisdictions.
But fundamentally, if you're a hot tech company, you want to go public in the U.S. because that's where the major investors are. So, you know, when people talk about IPO statistics, you have to understand there's different kinds of IPOs. So all the IPOs that are going on in China and Hong Kong are more generally traditional business. You need 3 years of profit, for example, to do an IPO in Hong Kong, so that doesn't work for a lot of tech companies. But fundamentally, what you're looking for is where the investors are, where that liquidity is. So if tech investors are all based in New York and Boston and various other cities in the U.S., that's why the focus is here, and companies aren't looking for greater listings. I think that's going to change. The global markets are going to become more and more, you know, transparent across markets. But for now, you know, again, you don't see a strong U.S. technology company considering going listing in any other market other than the U.S.
Question back there?
I'm just wondering, more on the legal side of things, how has Dodd-Frank and other securities regulation changes affected your job? Has it made it easier or more difficult, or has it really had an effect yet at all?
Gives us more work. In our perspective, it's probably more pain. I mean, I'll be honest, did SOX or Dodd-Frank make us a better company? Probably not. It helped do some structure. I agree there's some benefits to it. But from an expense perspective, we probably spend $2+ million a year just in the corporate governance obligations to maintain these things, between D&O insurance and all the auditors and the process we got to go through. If we didn't have that expense, we could drop out the bottom line.
I guess my view about SOX is that, you know, Congress passes laws to react to whatever the last crisis was. Enron occurred, so you had SOX. And SOX was thrown together in about 2 weeks, literally 2 weeks, and many of the people from both sides of the aisle didn't even know what they were voting for. But once it's implemented, you know, you don't want to look like you're weak, it's soft on crime, or soft on fraud, or whatever, so you have to leave it in. So you have these, you know, rules like the one about prohibiting executive officer loans. It was originally just going to be a disclosure item, but then one of the senators said, no, I want to prohibit it completely. It's in the law, and it's not changed since Sarbanes-Oxley. Dodd-Frank is more of a financial regulation. It does hit private equity fund clients of ours that never had to be registered with the SEC, now have to be. Even though they have nothing to do with causing what happened, you know, we all get sucked into it. So I guess on the good side, it makes the company more, you get more confidence as an investor that the company is a solid company. You know, America still has this perception of, you know, we have the cleanest companies. So that part's all good, but I think it's, you know, in many cases taking a bazooka to kill a fly. It's not really necessary.
Question, Becky?
What are your views on Chinese companies trying to list in the U.S., especially in terms of the recent cases of fraud? Do you take extra measures in due diligence against Chinese companies now, or any other measures?
Well, there's a range of, again, there's no kind of one bucket. You know, Chinese companies or American companies or tech companies, there's a range of them. So the good news, obviously the fraud issues have had a big impact on reducing Chinese listings in the U.S. It has had the biggest impact on the low end of the range, where there are lots of companies doing reverse mergers, and which is a process by which they kind of go backdoor way to become a public company in the U.S., where there have been lots of problems. So from a law firm point of view, particularly the kinds of law firms that we all represent, we are making judgments on those transactions as to whether or not it's a transaction, you know, threshold level that we want to be involved in. And you look at factors, you know, do they have, you know, Big Four auditors? You know, what's the management team like? Do they have an understanding of the U.S. issues and stuff like that? And a broad number of factors to decide whether or not you want to proceed in a transaction like that. So there's been definitely a fall off, and there will continue to be a fall off, I think, on the lower end of the market cycle. But at the higher end, there's tons of high-quality Chinese companies that are being funded by Western venture capital and increasingly Chinese venture capital. They're all being built on a model with an expectation that they're going to go public in the U.S., typically an offshore company, Cayman company, or something like that. And again, when their time comes, they're going to want to go public in the U.S. market, and the U.S. investors want to have participation in the Chinese market opportunities. And so, if the investors have the demand, and the companies are looking for the liquidity, you're still going to see a sizable number of Chinese companies going public here in my expectation.
Let's take a few more questions, then we'll go to have a cocktail. Go ahead.
Yeah. So coming from your background, what advice or what do you wish more tech founders would keep in mind or know as they build their companies towards these IPOs that would ultimately make them better entrepreneurs and better founders? Maybe what are your biggest frustrations?
So I think one thing I would look to is, as Rob kind of maybe talked about at the beginning, is getting prepared. I think there's a big difference between sometimes entrepreneurs and founders of the company who are brilliant people. I mean, we were a good textbook case. And at one stage, professional business people who really did get this, could understand this, deal with fairly sophisticated financial areas. I mean, the one thing I find myself, I never thought, God, this is the last place I'd be, was involved in the financial side. Daily, I'm involved with financial related issues. And I'm not a finance person. Fortunately, I got really strong people. I'm good, I'm not great. So bringing the professionals up front, getting prepared, looking on that road as much as you can to get prepared, bringing in teams of experts here. As Peter said early on, we were more like Lisa made the comment, that we had good corporate counsel. They were great for a privately traded company. But when we went, we knew we were going to go public. I needed somebody that I could sleep at night, who really eat and breathe and live the public realities on a daily basis. So bringing those people, getting that team prepared, things like investor relations, you don't think much about that. Those are critical. We made a mistake in an earnings announcement. We had talked about settling a case that we had in a lawsuit. And it was a positive thing, because we do have a lot of royalty catch-ups and enforcement and compliance-related issues. We had not prepped the street for that perspective. The street all of a sudden took and said, oh, that's not organic growth. Stripped it out, you missed the quarter. We lost $5 a share like that. And it was, we learned that lesson of, wow, we need to do a better job of getting the street, teaching them what it's about, what our business is like, so it's clear. These will be regular occurrences. And so it's getting those professionals lined up in advance.
And I'd say that the single most important thing is this notion that you have to replace people. And it's hard, particularly if the founder's still there and they have a tight-knit team, they built this big company. Well, it's just not logical to assume that all those people who are part of the original team are going to continue to have the skills and develop and grow at the right pace to run a really big company. And so it's really coaching from our point of view and working with them and understanding that probabilities are not that founding team somehow all will be able to survive and be, the public company manager.
There's a line in the Facebook S1 that says, in the risk factors, it says something like, members of our senior management have no experience, little or no experience in running public companies. I mean, Mark Zuckerberg is only 27 years old. He has done an amazing thing. He's created a thing that 1/7 of the world uses. And if it were, permitted in China, it would be even bigger. But he's never run a public company. So hopefully he's listening to his advisors about what he should do, people who have been through this before.
Let's take 2 more questions, then we'll go upstairs so you guys can interact more personally, and keep asking your questions upstairs. Well, the panel will stop with that easily. All right, you have food and drink. 2 more questions, sir.
So how are the pre-IPO markets regulated, and how are they affecting the IPOs?
Pre-IPO markets?
Right.
Well, I mean, there are no markets for companies before they are public. Now, there are these, services out there like Second Market that are trying to facilitate sales between shareholders of Facebook or Zynga or whatever and other investors who want to get into. This is how you get to the 500 shareholder problem that companies have, because this is all going on behind the scenes. And that market has become, as the IPO market has had more challenges, as Peter touched on, these secondary markets have actually grown. And we have some clients that have purchased significant positions in Facebook through secondary purchases from employees. It's all been permitted. The company knows about it. It's all been. But that is a definite factor that's happening. People want liquidity. Investors want to get into Facebook, and they can't do it until Facebook is public. And so this is one avenue that I think has started to develop more in the last couple of years.
I think one thing too that is interesting in those markets is there's imperfect information, right? Because they're not getting the disclosure that you are. So going back to my, efficient capital markets, right? The information is not the same. And so there's these prices out there. And I think one thing that is always interesting is when you go and you price an IPO, if your stock is trading at $32 a share on the secondary market, how does that affect what the market thinks your price for your IPO should be? Which is another thing that we're running into, I think. And the SEC has started looking into how much involvement do the companies have in these markets. Are they kind of facilitating the markets? Are they involved somehow? Are they aware of how they're using these markets to manage the 500 shareholder problem? It's kind of a new thing. It's only been coming up the last 2 years, and I think it's sort of, we'll see what happens with it.
Want to wrap it up?
Sure.
Okay.
I guess I have some experience with like venture capital and angel investing, and normally when you evaluate a company, I guess I'm a little bit in awe of the 85 billion valuation of Facebook. I'm kind of wondering what it is. And also your little anecdote about 25,000 revenue raising 85 million through the shares. What I'm wondering is what kind of valuation process? There obviously must be some other factors going into valuing a tech company that doesn't go into normal blue chip companies. And what I'm wondering is, if you don't have the profit and you don't have the revenue, and this is before they actually release it and let the market get at it, how is it you come up with an $85 billion valuation of your company?
Well, actually the valuation techniques are very similar. It's just that the input is different. So, and it's all based upon forward information. So the way you solve the not having profits now is that you look at numbers that they're going to be a year, 2 years, 3 years down the road. And then you can use any kind of valuation techniques, discounts cash flow, but mostly that's done on multiples. And so when they do an assumption, they say this kind of a company has this kind of growth rate. And the reason why tech is it gets such high valuations, it's all about growth. And so you're assuming that this growth is going to happen. And essentially companies have to grow their company into the growth rate that's been assumed to them. But that's what drives valuation. So you can have a very profitable, good quality company that has very little growth, and it won't get very much of a valuation. And you can have another company that has no profits, but people think it can be extremely profitable in 2 or 3 years and get a much higher valuation because it's so much forward-looking.
Well, listen, please join us upstairs, but before we go, let's say thank you to our panelists.